Focus. Ideate. Innovate. Enable.
Vanakkam. We are here in the beautiful city of Chennai. Our team of the investor camp at CNBC TV18 has travelled all the way to Chennai as part of our Inside Chennai campaign to get a sense of what the investors here want. And it's going to be a very interesting next 2 hours. Anuj, we have an eminent list of speakers who've joined us to tell us how to battle all the global and the local volatility.
Yes, Sonia, and in fact, it's nice breeze in Chennai right now, so not as hot as it normally is. And after Bengaluru, I'm really looking forward to Chennai, city of intelligent people,
yes.
Again a startup city as well, city of IT professionals. So it's going to be great, I think, and once again, by the end of investor camp, I hope to learn some more tricks and some more things about the market.
So this is a very tricky market, right? I mean, it's not an easy trade. You just, like it was about 8 months ago, where you go out there, you pick up stocks, and in 9 out of 10 stocks, you'll make money.
You're reaching a stage where it's almost panic situation. And as they say, be greedy when there's panic and be fearful when there's greed. It looks like, we're very close to panic, and a lot of stocks will be good buying opportunities. Maybe not on Monday, but at some point during next week.
In terms of individual stocks, Anuj, the theme for the last 6 to 8 months has been buy those market leaders in the business, buy quality companies, quality managements, and you will not go wrong. So whether it's a Sun Pharma, whether it's a Maruti, whether it's an MRF, an Eicher Motors, all these stocks, despite the volatility in the market, have done well. But now the question arises about valuations, about, how expensive can these stocks get? Should we worry about that, or should we still stick with quality names despite valuation concerns?
No, everything is good at a price. So obviously, at some point you have to take a look at that valuation parameter. But the sense you get is looking at the screen. There's so much global volatility. You want a bit of a safety in your portfolio. So that's a limited point I want to make. Even good stocks have corrected, Sonia. Look at Sun Pharma. That also went through a bit of a problem. Right now with the kind of global environment, and it's not that we have done extremely well in terms of our earnings or our macro data. We are still struggling despite the new government, despite the kind of hopes that we had. We still have to see transmission on the ground. We talk to so many corporates, and the body language is still not improving. So in that kind of environment, you still want to pay a bit of a premium for quality stocks and stick there. That's the sense I get.
Well, let's now listen in to what our first speaker, Atul Suri, has to say about the markets.
There is absolutely no dispute that the biggest wealth creator in this world is the power of compounding. There is no getting away. As Einstein said, it's the 8th wonder of the world. There is no getting away. I have not seen big wealth created over a sustainable period of time without the power of compounding. Though I'm a trader, I trade short term, maybe. I also hold long term. But the compounding power is what really makes a differentiator. Whatever you do, after paying 33% tax, your one arm is tied. The most beautiful thing that this government of India gives you is a tax-free long-term return. And you cannot match your portfolio with somebody who's paying full tax. Enjoy the benefits of long-term compounding, coupled with the fact that you're actually going to pay zero tax. That actually 80% of our results in life come from only 20% of our efforts. And 80% of our efforts that we make very often only contribute 20% to our lives. And that is also happens in our portfolio. We get very obsessed with having all winners. Like I predicted 10 stocks and all 10 were winners. It doesn't matter. What matters, and this is a beautiful line by Soros, that how much you made when you were right and how little you lost when you were wrong. Winning and losing is going to be in every trade, in every cycle, in every investment. Nobody can say I can have all winners. It doesn't happen. He's fooling you, he's lying. But the beauty is that how big is your winner and how small is your loser. You must have a focused portfolio. Whatever the number is, 10, 15, 20, that is why you'll find some of the best portfolio managers in this country. One thing I found common is that they have very focused portfolios. Whether it's 10, 15, 20, that's a number of semantics. But the need to have a focus, because when you get the trade right, it should make a difference. If a stock is a 10 bagger and it is 0.5% of your portfolio, over a long period of time, it's not going to move your needle. So the whole principle of 80-20, of having focused portfolios. People also invest in mutual funds. Sir, I have 20 mutual funds. It's not going to make a difference to your life. You're at the best going to get only portfolio returns. So look at focused portfolios, look at focused trades. And no one spells it better but George Soros. Whenever you look at trades or investments, you have to look for trades with asymmetrical returns. Asymmetry means small downside and a big upside. And that is why, some of my friends in the media may be offended by this, but very often you see people on TV saying that, buy a stock at 100, stop loss 90, target 110. So what do you have is a 1:1 risk-reward ratio. You can never make money in the long run, that strategy. You can never make money. Because the beauty is that never do you get 10 out of 10 trades right. You're going to have losses. And when you build in brokerage, when you build in slippage, you will notice that you can never make money. Because we do not have an estimation of a realistic strike rate, which is the second point Pabrai points out. Someone comes and tell you, boss, I gave you 10 trades, all trends are right. It's a lie. Nobody can have all his 10 trades right.
Principles I've shared are not about technicals or fundamentals, investing and trading. But these are classic wealth creation principles which run through all these great masters, and all these great masters have thought out and created immense wealth. So I've tried to share something much beyond the textbook. I've tried to share 25 years of learning in 25 minutes.
I'll give you a case of a very, very famous hedge fund in the US called SAC Capital. It's now wound down by a trader called Stephen Cohen. Stephen Cohen is one of the best traders in the world and one of the best performing hedge funds in the world. And he says, my best trader gets only 64% of his trades right. So even the best trader gets only 6 out of 10 trades right. Because losses are a part of the game. And if you have a 1:1, and we are not the best, we know that. At least I am not, I know that. So at the end of the day, even if I get half my trades right and wrong, and I have a 1:1 risk-reward ratio, post-brokerage, post-slippage, I am losing money. And that is what happens with traders very often. And this again emphasizes the first point of the power of compounding. That you have to have asymmetrical returns. Because all your trades cannot be right. If your risk-reward ratio has to be, 1:5, 1:10, even for a trader. Because even then, if you get 2, 3, 4 trades, which is a realistic strike rate, you will still make money. But expecting all your trades to be right with a 1:1 risk-reward ratio, by pure mathematics, you can never make money.
Well, that's Atul Suri talking about the key learnings that he has had from a lot of the market gurus, not just in India but globally. But let's do one thing. Let's take a short break. When we come back, it will be all about stocks. Stay tuned.
Welcome back. You're watching the special investor camp from Chennai, and before the break, of course, you heard from Atul Suri about all the key learnings from market grades. But Sonia, our next speaker specializes in multi-baggers, and he has given so many multi-bagger ideas. So a lot of our viewers want to know the next multi-baggers. So here's Porinju Veliar.
I would tell you my experience, equity investing as a disciplined value investing has potential to create enormous wealth. Nobody can question that. It is a proven thing, and I'm very proud that I have proved it for others too. There can be two approaches to equities. One is keep it very simple, be a value investor, and some others they complicate it with too many things, too many aspects and developments. In 90s we never thought of American GDP, how much it grows. Maybe after 1 year we see how much it has grown in the last 1 year. Here people are looking weekly basis or monthly the report. People are looking at the US job data. They are seeing it 1 week in advance. On that day the US job data comes. The Indian traders I'm talking about. They look at the bond yield, the Greece bond yield. They look at the Chinese PMI. And so many things people have been looking at, and we have internally, when the Met Department is going to predict the monsoon, when RBI is going to meet. These are the most important aspects of value investing for a lot of people today. That is the reason you are seeing this volatility, too much volatility. This is artificially created because of ignorance of the majority participants in the stock market, I would say. It's very sad. And this is on an increase. The new generation who don't want to work hard and make a good career in technology or in a medicine, whatever, engineering, they come to the stock market, open an account, and some of them open 3 or 4 accounts with 3 or 4 brokers and multiple DP accounts. It is amazing. I'm telling you, money cannot be made that way. Keep it simple also is very, very important. I'm disappointed the way the newcomers in the market, the amateurs, just after graduation they come and they start trading or investing in the market. What are they looking at? Okay, Q1 numbers of the company. That is their first priority when they look at the company. I believe India will be outstanding in the given global environment. There is so much panic happening around the world, and basically all followed by the slowdown globally, and the symptoms have been there since some time. Now it has come to some kind of trigger, and every market, the commodities, the economies are reacting to that. India is standing out and we are in a sweet spot. Indian equity investors have great potential to create enormous wealth by value investing in a disciplined manner. And India has so many companies which are not in fancy today, which are not talked by the media, but some of them are great values, and most of them are still you can find in the mid cap and small cap segment, and aspiring to go to the next level of growth. And some of them may have their own challenges today, some negatives which are curable, and the changing profiles of Indian companies is another major thing. These changing profiles with regard to the balance sheet, the promoter quality, the business environment, and it is going to create multi-baggers. People are so much struggling and they are looking at companies first time. Now, I have been warning on many platforms, including television channels, not to chase fancied companies, famous stocks in the market. Last 1 month, a lot of people, they have been experiencing, I'm going right in that. The stocks going up by 5-10 times and 60, 70, 80 price earning multiples. They might have got 1 or 2 good quarterly numbers. And the people coming first time into the stock market, they feel buying these companies which have gone up by 10, 20 times, quoting at 60, 70 PE, which has got some moat kind of things, that is the safest in the market. And they go and buy first time, they buy these kind of companies. Whereas we have real values beyond these companies,
We have one more speaker, Kapil Bali, and here are some more stock ideas.
Basically, there are 2 kinds of stock picking which you can do. One is on a short-term nature, one is on a long-term nature, which everyone knows. Second is on a technical analysis basis or a fundamental analysis basis. Third is all these big words, which is value picking, growth investing, or even momentum investing. In the end, are you making money? That is the bigger question. So to my mind, from a time frame perspective, if you can devote a lot of time in the market, if you are a professional in the market, then I think trading should be your bet, if you can spend that kind of time in the market. If you cannot spend that kind of time and you have other things to do in life, then I think you have a long-term perspective in the market. And as speaker after speaker is saying, long-term, sitting on stock, that is equally benefiting. In fact, largely, it may be even more benefiting than maybe short-term.
There are 2 options or 2 kind of investors. So if you have invested in good quality stocks, you are convinced about your investments, and this is a global sell-off which will affect us also, then I think we should stick with our conviction and maybe use these rallies to shore up and maybe average out more on our stocks. Second, if you are entering this market or planning to entering the market, I think it's a great time to enter, as you may end up getting a lot of great stocks at great valuations.
I think the world is coming to terms with whatever is happening in China. there is a big adjustment happening. The world's second largest economy is slowing down. There is a shift in trend in the last 2.5 decades. So the world markets are adjusting to it. You or I or India hasn't done anything wrong. Only thing is we have to keep doing something positive. But there is an adjustment going on. And that adjustment will happen. So even if, and China, being China, they really interfered in their markets and tried to do a lot of stuff, which I think all of us have read, whether it is the market, whether the yuan. But believe me, open market policies will play a huge role. So I think the only thing that we are trying to say, in all this, the Indian markets come out as to be a great place once the emerging markets bad tag goes away. So I think it's just a matter of time. They have not run away. They have not taken out their money, but they are just waiting and watching whatever is happening in their home and whatever is happening in other parts of the world, especially in China.
Okay, with that, let's head into a short break, but don't go anywhere. When we come back, it will be the most fun part of the investor camp, the interaction with our investors. Stay tuned. Welcome back. You're still tuned in to the Investor Camp and we're here in the beautiful city of Chennai. It was a very interesting first 1 hour where we heard a lot about what the experts have to say, but now comes the fun part where our investors have a lot of questions to ask. Take a look.
What kind of a bottom can we expect in the market for whatever reasons, either globally or in India? And alternately, do we see any kind of upward trend beyond 27,000-28,000 in the foreseeable future?
I think that India as a country will, if there's a big global sell-off and to expect that India will do well or just be green, no, that doesn't happen. There will be a knockdown effect. But where I see that India will relatively outperform, in the sense that even if it falls, it will be among the lesser. It will fall the less. And I think one of the big positives for India, actually two big positives for India I've seen in the last 3 to 6 months in the face of a global commodity meltdown, is that we are big commodity importers. So we tend to be very, very dependent on commodities. I think India's macros are getting better. And this will sort of pan out over a period of time. But yes, when you are having basket selling in emerging markets or, general equity sell-offs, these global macro or quantitative guys do that, you are going to get whacked. But I feel that India will relatively fall less, and when markets stabilize, we'll be among the fewer markets that will actually emerge and move up higher.
So as retail investors, do we need to focus more on the cash flow rather than the wealth creation? So which is very much important for a retail investor?
From a retail perspective, I think cash flow is also important in life. So we cannot just wait for wealth to grow and then obviously. So there has to be a mix of, as per my opinion, mix of your portfolio. One is where you have your baggers, where you're going to sit on it for a long term, and then there has to be a combination of stocks which either can meet your 15-20% kind of returns, and there has to be a cash flow. Without cash flow, there is no fun.
Today, a lot of stocks are trading at a rocket valuation of 80p, 100p, 120p with a minimal growth, and there few have sustained growth. Some investors have invested already in, let's say, 2013 or 12 and happy to be accidentally a good return. What does investor has to do if he has a long-term horizon? Should he exit and say 100p, if you have to go back 2000 when IT had this run, you saw 5-6 years of extremely bad return. Or say 10 years I'm going to take a call, strong company, let me hold on and make an average return. What is your thoughts on that?
The best way is not to get excited with the stock price movement. See, when we buy and hold a stock, it goes up 1x, 2x. So we get more and more bullish. It's a human tendency. Things over some point of time. At what level of PE this business looks? We can't give a same PE for every company. At what PE this particular business managed by such and such people with so much futuristic potential? At what PE this can trade? If a company is a fantastic company, great management, beautiful business, there is a moat, there is this thing, everything is there. And if the company is priced for the next 5-year fundamentals, I think you can sell it when you realize that and go into another stock which can be another multi-bagger. which is not in fancy today, which is at reasonable valuation, this company also has a potential to grow.
But there is a risk of losing out by getting into another stock.
You never lose out. This country has so many great companies.
Okay.
I think that losing out, that's the best feeling an investor can have.
That was the Q&A, and that was the best part of the investor camp for me, Sonia.
Oh yes, it was. And you know what, Anuj, we've learned so much in the city of Chennai, but we can't wait to get to another city, right?
Indeed.
So until we see you in another city, thanks for watching Investor Camp.
Focus. Ideate. Innovate. Enable.